Let's get to our market commentary of the day. And for today, it's a note out from Bank of America saying that they see a probability, or the possibility, I should say, of more trouble ahead when you take a look at the S&P 500. So the strategist there, Michael Hartnett, saying that the index is at risk of dropping another 5% after falling below a key technical level this week. The S&P closed the day Thursday below 4,200, just shy of a technical correction, which would be at or below 41.30. Now, this coming as stocks are about to wrap up a third month of declines driven by seasonal trends, as well as the surge that we certainly have seen in yields. Still, though, according to Bank of America's Hartnett, we are looking at tech stocks. They are under high demand, attracting about $2 billion of inflows as giants in the sector reported earnings this week. And I think my takeaway from the action that we've seen this week, and also from this note here from Hartnett, is just the fact that the turnaround story that we were waiting for, whether or not tech stocks, the large, the Magnificent Seven, were going to be able to turn around this market momentum. That doesn't seem to be the case. So then, of course, that brings up what exactly is in store for the markets here going forward. And according to Hartnett, since we did drop below that 4,200 level, the next level we're going to watch is just above 3,900. When you take into account the fact that the NASDAQ is already in correction territory, we're getting conflicting reports out from a lot of these large tech giants. When you take a look at Microsoft, Google, Meta, Amazon, all reporting this week. Google really spooked the street. And we talked to BlackRock's Rick Reeder earlier on in the week, just talking about the fact that he sees this real dispersion, referencing the earnings reports that we got from Alphabet and from Microsoft, saying that we're getting a series of conflicting signs around the markets. And that's why the markets are so jumpy, so uncertain. So when we see any sort of reason to worry, we certainly are seeing that worry then reflected in the broader market.
And again, to your point about that trend line to be watching out for, that 39.41 level when it comes to the S&P 500. And you can see the bulls fighting back in terms of keeping, today, moving away from what we saw yesterday in terms of that that level that we were watching yesterday, that closing at 41.37. Now we have some buying action today as investors kind of try to create a floor there. And that 39.41 level considered a key level because it's kind of halted worse in the past. Hartnett pointing out, that there were some exceptions there when you think back to the dot-com bust and of course, the financial crisis where you broke through those levels. So right now, we know that a headwind that everyone has been watching, and Hartnett calls this out too, is yields and what's happening with regard to yields and what that could do in terms of any kind of breakdown in technicals.
Yeah, it's important to point out that we know Hartnett obviously has remained bearish throughout this year, even when we did see the rally in the first half of the year, obviously led by the Magnificent Seven. But I think coming out of this week, and as we look ahead to Apple, just what exactly is in store for the broader equity market between now and the end of the year, given the fact that also obviously another massive headwind is the massive run-up that we've seen in rates.
Indeed. And can the Magnificent Seven continue to hold up the market? And can they pull in any more inflows? We will certainly be watching that, especially when we see Apple report coming up.